So financial reporting, let's move to one more chapter, that is taxation. Taxation. In this chapter, we'll cover about two concepts of taxation. One is relating to current tax, and other is deferred tax. Current tax and deferred tax. So let's discuss current tax first. Suppose this is our year end that started from 1st of January 2023 and ended on 31st December 2023. After this, we will be having next year that will end on 31st December 2024. Okay. So our current year is say 2023 now. This means for this year, the tax amount that is charged to profit and loss account, how we can calculate? So we'll calculate profit before tax and we'll charge tax rate and we can calculate tax expense. At what date? At this date year end. In whatever is the profit before tax between 1st January to 31st December, we will charge a tax rate on that profit and we will calculate tax expense for 2023. What accounting entry we record for tax? Debit tax expense and credit tax pay. Because we do not pay at the year end. We normally pay after year end. So we record accounting entry tax expense debit and tax payable credit. So the tax amount was $10,000. So we recorded this accounting entry at 31st December 2023. Where we will pay, suppose we are paying tax here. April, March, whatever is the month. Then we pay tax. It's not necessary we pay the same 10,000. Meanwhile, paying tax amount could be different. Tax payment could be different than the tax expense. Why? Might be we have recorded some expenses, but the tax authority do not allow those expenses to be deducted from the profit for tax purposes. Might be we recorded some depreciation based on straight line basis, while tax department says, no, you need to depreciate this asset based on reducing balance basis. So due to this, the tax payment could be different. So we recorded tax at year end 10,000. This was estimation of tax. Mean we estimated according to the current profit, like we need to pay 10,000 tax in future. Mean we created a tax payable liability. This is called we created a provision of 10,000. Mean we created a provision of 10,000, mean 10,000 tax we need to pay in future relating to current year. But while paying, amount could be different. While paying, amount could be different. Suppose while payment we paid 8,000. The tax authority says this should be the adjustment in your tax calculation. So actually you need to pay us 8,000. This means if we are paying 8,000, how much provision we created at the year end? 10,000. This means our that provision was more. So we'll call it over provision. By how much? 2,000. Can you understand this? If suppose we paid 15,000, I mean, according to our calculation, tax amount was 10,000, while according to tax department calculation, the tax we paid 15,000. This means we created provision of 10,000. We actually paid how much? 15,000. This means that provision was what? Under provision. So we'll call it under provision. By how much? 5,000. So this is tax payment. Can you understand the concept of under provision or over provision? What to do with this under provision or over provision? This under or over provision will be adjusted in next year tax calculation. Now suppose we move towards 31st December 2024. And for this year, we calculated tax expense, say 12,000. Mean we recorded accounting entry debit tax expense with 12,000 and credit tax payable with 12,000. But we record current liability with the 12,000. But tax expense charged to profit and loss account will not be 12,000. In this 12,000, we need to adjust previous under our overpayment. Mean for this tax charged to P&L, we need to calculate how current tax liability. How much is that? 12,000. If previous provision was under, we will add to it. If previous provision was over, we will deduct from this. So previous provisions was under by 5,000. So we will add 5,000 in that. And the amount now we have calculated 17,000 that we will charge to profit and loss account as tax expense. In current year profit tax that is going to charge to P&L, we need to adjust previous under or over previous. We don't need to do anything with the tax liability for the current year. We don't need to do anything with the tax liability for the current year. First, we need to calculate tax according to profit before tax of current year. We will pass the accounting entry tax expense debit tax payable, tax liability credit. Liability will remain same. But in P&L, what is a tax expense we need to charge? We need to charge for the current year liability plus minus previous under or over premium. Suppose at this year 2023, there was some under or over premium relating to 2022. So we need to adjust. Can you understand this? This is the concept of current tax. How we record current tax, current year tax liability. If there was a previous under premium mean we actually paid more. We actually paid more, but we charged liability less. So remaining we will charge now by adding to the current. And if there was previous over premium, that we will deduct. Why we will deduct? Because we created liability more in previous while we paid less. So that more liability that we created in last year, that we will deduct in current year. Can you understand this? Under or over premium, what is under premium, what is over premium, and what to do with under or over premium for 1 year, that will be adjusted in next year tax expense that is charged to the profit and loss account. So this is the concept of current tax. Are you with me? Shall we move forward? Okay, this was basic accounting that we have already studied at financial accounting. Now we are moving towards additional concept, that is deferred tax, that was not in financial accounting, that is in financial reporting, but not in full depth. A little bit here and little bit complexity will be in SPR. In tax paper, there is no deferred tax concept. That is something different. While calculating tax, what expenditure should be included in expenditure, what are the allowable, what are the disallowed, how to calculate income tax, how to calculate company tax, how to calculate property tax. So that is different. Deferred tax is a concept relating to accounting. Okay. So this formula, if we see tax charge to P&L, what's the formula we have created? Current tax liability in that we need to add under provision. If there is over provision, we need to deduct to calculate what? Tax charge to P&L. In that, we need to adjust one more thing. In that, we need to adjust one more thing. What? We need to adjust increase or decrease in deferred tax. Increase or decrease in deferred tax. If there is increase, that will be added. If there is decrease, that will be deducted. Then we can calculate tax charge to profit and loss account. If there is consequence of deferred tax, then while calculating tax charge to P&L for current year, we need to adjust one thing more. What is that? Increase or decrease in deferred tax. What is deferred tax? We don't know. How it is calculated, we don't know. But while calculating figure for tax of profit and loss account, how to calculate profit and loss account tax figure for the current year, current tax liability, adjustment of previous under or over provision, and adjustment of deferred tax. And in this formula, no deferred tax was there, but we have just added increase or decrease relating to deferred tax. We don't know yet. Deferred mean future. Deferred mean future. Mean tax that will be settled in future. Deferred tax, tax that will be settled in future. Either we recover in future, either we pay in future. Deferred tax mean tax that will be settled in future. Either recover, either pay. If we have paid less, we will pay more in future. How much we will pay more in future, that is deferred tax liability. If we have paid more now, we will recover in future. That will be deferred tax asset. Deferred tax mean tax that will be settled in future. Either we need to pay. This means currently it is deferred tax liability. Either we need to recover. Currently that is deferred tax asset. Can you understand this? Yes. Shall we move forward? Remember this formulas. Current year tax liability that is calculated on current year profit, that is also called estimated tax. That is also called estimated tax. Current year tax estimation. Why it is called estimation? We are thinking like based on current year profit, we need to pay this tax. But actual payment could be different. Actual payment could be different. So current year tax liability that is based on current year tax estimation. In that we need to adjust under or over provision. Under provision we will add, over provision we will deduct. And we need to adjust increase or decrease in deferred tax. This over provision we need to add. Under provision we need to add. Over provision we need to deduct. In which? In tax. Tax is a expense having debit balance. If we are adding under provision to tax, so under provision will also be having a debit balance. So we will call debit balance of provision. Because tax is expense. And under provision we are adding. So debit we can add. This means this over provision that we are deducting will be having credit balance. We are discussing something that we need to remember. How current year tax expense charge to P&L will be calculated. Current year tax liability, adjusting under or over provision, adjusting increase, decrease in deferred tax, we can calculate tax charge to P&L. Under over provision having no link with the current year tax liability. Tax liability will be based on current year profit tax. In tax liability will not be calculated with the adjustment of under over provision. Only tax charge to P&L will be adjusted with under over. Okay. So let's move forward. a bit technical chapter. I'm trying to make it a bit easier. So IAS 12 income tax state that there are two elements of tax that need to be recognized in financial statements: current tax and deferred tax. Current tax, the amount of tax payable, recoverable in respect of the taxable profit loss for a period. And deferred tax, an accounting adjustment aimed to match the tax effect of transaction to the relevant accounting period. Mean this is the adjustment that we need to make with the current year tax charged to P&L. Okay. Mean for the current year tax, we need to record the accounting entry tax expense debit, tax payable credit. What is the under provision? What is over provision? Under provision increase in tax charge mean we need to add, and over provision is a decrease in tax charge mean we need to deduct. Why we need to add, why we need to deduct, we have discussed. Illustration 1. Simple has estimated its income tax liability for the year ended 31st December 20x8 as 180,000. Mean they have charged accounting entry tax expense debit, tax payable credit with 180,000. In the previous year, the income tax liability had been estimated as 150,000. While previous year, tax liability was 150,000. How much they paid for previous year, we don't know yet. Calculate the tax expense that will be shown in statement of profit or loss for the year ended 31st December 20x8. How to calculate this? Current tax liability plus under provision minus over provision and adjust deferred tax, increase, added, decrease, deducted. We can calculate P&L figure, mean this figure they want. So it is current year liability. That is 180,000 that is given in the question. So calculate tax expense that will be shown in statement of profit or loss for the year ended 31st December 20x8. If the amount that was actually agreed and paid to tax authorities in respect of previous year was 165. What was tax liability previous year? 150. If they paid 165, that liability was under by how much? 15,000. So in current, we need to add under provision that is 15,000. So current that will be 195,000 for part A. Done. What is part B? Current tax is 180. Previous estimation was 150, but they actually paid 140. So that was over by 10,000. So over 10,000 should be deducted. So that will be 170,000 for behind. Is that? Not 95, 170 they have calculated. Now we are moving towards deferred tax. Deferred tax. There are two terms that we need to learn, that is accounting profit and taxable profit. Accounting profit and taxable profit. Accounting profit, the profit that we calculated according to our accounting records. That will be called accounting profit. Suppose we charge depreciation of asset based on straight line basis. We bought our asset with the 5,000. Life was 5 years, so we charge 1,000, 1,000, 1,000 every year. What is taxable profit? The profit that is calculated according to tax department or tax authorities rules. They said, no, you cannot charge depreciation based on straight line basis. You need to charge depreciation using reducing balance basis. And the rate will be 20%. This means in initial year, the depreciation will be more. In subsequent year, the depreciation will be lesser. So if there is a difference between accounting profit and taxable profit, there will be deferred tax. Either deferred tax liability, either deferred tax, etc. Accounting profit that we have calculated according to our records, according to our business rules. While taxable profit, according to tax authority rules. And that could be different. We have created a provision expense, warranty provision expense in the financial statement. And we calculated profit by including warranty provision expense in financial statement. While tax authority says no, you cannot deduct this warranty provision expense while calculating profit. This you can deduct when you will pay this provision. So according to them, this means we need to deduct that warranty expense from the expenses. And by deducting this, profit will be more, tax amount will be more. So there is consequence of deferred tax. So tax accounting profit according to our records, mean our profit, actual profit that we have calculated. While taxable profit, tax department profit. Tax according to tax department, profit according to tax department. So they could be different. Why they could be different? Due to different depreciation, due to provision or something else. So accounting profit are the reported profit, which is the figure for profit before tax shown in statement of profit or loss and reported to the shareholder in the published financial statement that we prepared at year end. While making payment of tax, we need to calculate profit again according to their rules that we will not show to shareholder. But that profit figure could be different. So that will be called taxable profit. So a taxable profit, which is the figure for profit calculated in the entity's tax computation on which taxation authorities base their tax calculation. In according to tax authorities. So this is according to entity, mean company. And this is according to tax authorities, TA, tax authorities. This profit could be different because they allow some expenditure more, some expenditure less. Can you understand? Tell me. Yes. Suppose there are two terms. One is actual profit. That is accounting profit. Other is called tax authority profit. Mean taxable profit. If actual profit we have calculated more, while according to taxable authority, profit was lesser. our actual profit was more. According to taxable authority, profit is less. We know we calculated profit accurately. But now, according to tax authorities, we need to deal accordingly. This means if actual profit was more, we calculated tax more. According to tax authorities, tax amount is lesser. We need to create deferred tax liability. Mean there will be deferred tax liability. Because we know we calculated this profit based on our records. We are having accounting records. And those records we prepared according to accounting standards. But they are not allowing a certain expenditure now, probably they will allow in future. Mean this tax we need to pay in future. Because they are not allowing these expenditure now. Like provision we included in the profit calculation, they say no, this provision should be included when you will pay. Ultimately, in future, we need to include this provision in expenses, mean this tax, the difference happening now, we need to be pay in future. So as we need to pay in future, so we will create what? Deferred tax liability, mean this tax will be settled in future. That's why we're gonna record it as liability. Tax are saying no, you cannot record these expenses now. They're saying you will record them later. Later. So when the tax allows, like we created warranty provision as expense. Yes. They say no. You cannot deduct this warranty provision expense now. You can deduct when you will pay this warranty. This means when we will pay in future. So in future, ultimately, that will be included in expenses. And it will get settled. Exactly. So that's why we will create tax, deferred tax liability. Can you understand this? If our actual profit are lesser while taxable profit are more. Actual profit are lesser, taxable profit are more. In that case, we will create a deferred tax asset. Just to remember this, further we will discuss logically later. So why deferred tax arises? Due to difference between accounting profit and taxable profit. Mean actual profit and tax department profit. Why this happen? Due to difference in accounting profit mean actual profit and taxable profit mean tax department profit. Let's move towards our question. Test your understanding one. The company's financial statements show profit before tax of 1,000 in each of year 1, 2, and 3. What is this? Accounting profit. This profit is stated after charging depreciation of 200 per annum. In straight line basis. Due to the purchase of an asset costing 600 in year 1. Is that? In year 1, we purchased asset with 600. So 3 years was live. So we charge 200 each year. And based on that, for year 1, year 2, year 3, our profit before tax is 1,000. And to calculate this profit, this 200 expense was deducted. Is that? Okay. Which is being depreciated over its 3-year useful life on a straight line basis. The tax allowance granted for the asset are 240, 210, 150. While tax authority says no, you need to charge depreciation 600. But how? 240 in year one, 210 in year two, and 150 in year three. Altogether, it is 600. But they are not allowing us, you can charge 200 each. Income tax is calculated as 30% of taxable profit. According to our actual profit. What is actual profit? 1,000. How much tax we are charging? Based on 1,000, 30%, 300, 300 each. According to actual profit, our taxable profit, how much tax we are charging? 300 each year. Apart from the above depreciation and tax allowance, there are no other differences between the accounting and taxable profit. There is only one issue due to which the taxable profit could be different. In fact, different. Ignore deferred tax. Prepare statement of profit or loss extract for each of year 1, 2, and 3. In ignoring deferred tax, can you prepare statement of profit or loss extract for each of year 1, 2, 3? Can you prepare this? If tax department saying you need to charge depreciation this rather than this, what is profit before tax and tax up? You need to calculate profit after tax. Profit. Year 1, year 2, year 3. Is that? What is your profit? 1,000, 1,000, 1,000. What happened? How much is the tax? This is profit before tax. If we deduct tax from this amount, we can calculate profit after tax that they are requiring. Deferred tax. Tax allowance and everything, we can ignore. We should ignore deferred tax. Yes. What is profit after tax? So ignoring deferred tax, prepare statement of profit or loss extract for each of the year 1, 2, 3. I mean, there is no consequences of deferred tax as a deferred tax liability. Based on this information, you need to calculate what extract of profit and loss account. How we can calculate tax? Working one, tax calculation. Mean we are having a profit of 1,000, 1,000, 1,000 that is based on 200 depreciation. While tax department says no, you need to charge 240, 210, 150. So whatever depreciation we have charged as expense, that we will add back. And whatever they are seeing, that we need to deduct how much? 240, 210, and 150. Based on this, we can calculate profit before tax. That is what? 960. 1000 plus 1200, that will be 990. And 1000 plus 1200 minus 150, that will be 1050. Tax rate is what? 30%. So what is 30% of 960? 288. 288. Yeah. What is 30% of 9? 297. 297. And what is 39? 315. 315. That we will charge here to double it. 297 and 315. So we can calculate profit. How much is that? 712, 703. That will be 685. Part A done. Part A done. Move forward. Now moving towards part B. Accounting for deferred tax. Prepare statement of profit or loss and statement of financial position extract for each of year 1, 2, and 3. Now, according to deferred tax, first we need to calculate deferred tax for each year. And then we need to prepare extract of P&L and balance sheet. Deferred tax arises due to difference between counting profit and accounting profit and taxable profit. Accounting profit is 1000 each. What is taxable profit? 960, 990, and 1050. Accounting profit is 1000, while taxable profit is 960, 990, and 1050. And due to this, the difference is called deferred tax. So we are having 3 years. We are having 3 years. Year 1, 2, 3. If we see year 1, 2, 3. So tax as per accounting profit. How much is tax as per accounting profit? 30% is the rate. 1000 is accounting profit R. So that will be 300, 300, 300. What is the taxable profit tax? Tax department tax. So tax as per tax department. That is 288, 297, and 315. So the difference will be called deferred tax asset or liability. Deferred tax asset or liability? Liability. Why? Because actually our tax is more we know, but we have paid less according to them. So that will be settled in future. So deferred tax liability, how much will be that? 12, 3, and minus 15. That will be asset. But that is not asset yet. That is not asset yet. Okay. This we have calculated now. Now we are moving towards calculating P&L figure and balance sheet figure. So P&L figure we have already calculated. Now in statement of financial position, for year 1, 2, 3, we need to record deferred tax liability. For year 1, it is 12. For year 2, we have calculated 3. What was the opening balance? So that will be 15. For year 3, we calculated negative 15 based on the difference between tax. What was the opening balance? There will be nothing. Will not say this is deferred tax liability. No, this is increase or decrease in tax. Due to the difference, this is increase or decrease in tax. But how to calculate deferred tax liability? Obviously, it's giving indication of deferred tax liability. Mean for year 1, that will be 12. But for year 2, current 3, mean the difference plus opening balance. What was the opening balance? That was 12. So for year 2, that will be 15. Year 3, the current difference, negative 15. What was the opening balance? Positive 15. So that will be recorded in a non-current liabilities. This deferred tax liability, where it will be recorded in a non-current liability. Because going on. In current liability, we will record tax payable. How much? 300, 300, 300 each. That is based on accounting profit. Can you understand this? Weekend is more like in year 2 is more. What will happen? For year 2, it's a 3 increase or decrease in tax. But the previous opening balance was 12 plus current increase, decrease 15. So for year 3, the current is negative 15, but previous opening balance was a 15. So negative 15, there is nothing. Can you understand this? In deferred tax, how to calculate actual profit, mean accounting profit tax minus taxable profit. The difference is increase or decrease. If actual is more than taxable, there will be liability that we have calculated for year 1. And for year 2, the difference plus previous opening. And for year 3, the difference plus previous opening. So that we have calculated for statement of financial position. This is one way of calculating deferred tax liability. Now we are moving towards another way of calculating deferred tax liability. I mean, this is concept. But how we will make a calculation in question, that we are going to study now. Okay. Now we can read something. What is deferred tax? The estimated future tax consequences of transaction and events recognized in the financial statement of the current and previous periods. Deferred taxation is a basis of allocating tax charges to the appropriate accounting periods. The key to deferred taxation lies in the difference between two profit figures, accounting profit as per entity and taxable profit as per tax authority. Why they could be different, we have discussed. Due to different depreciation, carrying amount could be different, or due to some expenditure allowed or disallowed for tax purposes. Accounting profit and taxable profit, difference between accounting profit and taxable profit may be caused by permanent differences and temporary differences. What is permanent differences? Suppose we recorded a expense while calculating the profit, while tax authority says, no, you cannot deduct this expense for tax calculation. Like we provided some entertainment to our staff. Suppose we enjoyed a movie with the staff. There was expense. We included in business expenses. And we have calculated profit and tax. Tax authority says no. This is not business expense that you are deducting and calculating tax. This is not allowable expenditure. Not even now, not even in future. So that is called permanent difference. So permanent difference, in case of permanent difference, no deferred tax effect. What is temporary difference? Some expenditure tax authorities are not allowing now, but they will allow in future, like provision, when you will pay, you can deduct as expense. We charge depreciation different. They are saying, no, you need to charge depreciation different. Ultimately, over the period, the depreciation complete will be 600. But according to them, no, you need to charge lesser now, more in future, or you can charge more now, less in future. So ultimately, that will be settled in future. So that is called really difference. So deferred tax arises due to taxable temporary difference. Deferred tax arises due to taxable temporary differences, not due to permanent differences, due to taxable temporary differences. Temporary differences are of two types. Taxable temporary difference and deductible temporary differences. Taxable temporary differences will be having a positive figure, while deductible temporary differences will be having a negative figure. In case of taxable temporary differences, there will be deferred tax liability. And in case of deductible temporary differences, there will be deferred tax asset. How we're gonna study it? So deferred tax arises due to temporary differences. Due to temporary differences mean this expenditure either will be more or less in future. Permanent differences, this expenditure will not be included in future. So deferred tax arises due to temporary differences. And if due to that, taxable temporary differences mean positive figure, how it will be calculated, we're gonna study now. Deductible temporary differences mean negative figure, how we're gonna calculate, we'll study now. In case of positive figure, we will call it taxable temporary difference and call it deferred tax liability. And if the figure is negative, we'll call it deductible temporary difference and call it deferred tax asset. How this can be calculated, positive or negative figure, there is a formula. What's the formula? We need to study this permanent difference and temporary difference. So the accounting problem, the reason that deferred tax should be recognized is that the profit for tax purpose is likely to differ from accounting profit in the financial statement. Hence, the current tax expense may not correspond to accounting profit. These differences may be permanent or temporary. Permanent difference arises if, for example, an expense in the statement of profit or loss is disallowed for tax purpose. For example, entertaining expense. And tax expense increases as a result. So due to this, there will be no effect on deferred tax. Temporary difference arise when an item is allowed for both tax and accounting purposes, but amount lesser or more. But in different accounting periods, for example, if tax relief for capital expenditure is given at a faster rate than the accounting depreciation, mean depreciation rate could be more or less. The current tax expense will be lower in the earlier years and it would have been if base of the accounting profit. However, in a later years, the tax charge will be higher. Mean the depreciation amount could be more or less than our accounting profit. Mean according to tax authority, might be we have charged depreciation 1,000 now. They are saying no, you can charge 1,500 depreciation now. We have charged 200 depreciation for first year. They are saying, no, you need to charge 240 for first year. Because this is a machine. As it get old, it provides less benefit. So depreciation will be lesser. Temporary differences are differences between the carrying amount of an asset or liability in the statement of financial position and its tax base. Carrying amount, tax base. These two terms. Due to this, there will be taxable temporary difference. What is meant by carrying amount? According to accounting profit. Carrying amount mean according to accounting profits. Mean we charge some depreciation, and according to that depreciation, carrying amount of asset is say 10,000. While tax department says no, you need to charge more depreciation. According to that, carrying amount of asset is say 8,000. That is according to taxable profit. Mean according to tax department, the carrying amount according to tax department is called a tax base. So what's the difference between them? 2,000. This is taxable temporary difference. We will call it deferred tax liability. This into tax percentage will be tax. Exactly. We need to charge tax percentage on it. This will not be deferred tax liability. We need to charge, say, 30% is the tax rate. So 30% of 2000 is what, say, 600. So that will be deferred tax liability. If accounting profit is more than taxable profit, there will be deferred tax liability. If carrying amount is more than tax base, carrying amount mean according to accounting profit. Tax base mean according to tax department. According to tax department. Tax base mean according to tax department profit. Divided by value of asset, calculation of profit, depreciation charging. So carrying amount mean accounting profit. Mean according to our books. What depreciation should be charged? What should be the carrying amount of asset? While tax base according to tax department calculation. What should be the depreciation? What should be the profit? What should be the carrying amount of asset? And the difference is positive. The difference is positive. We will call it taxable temporary differences. And if suppose this figure is negative, like a carrying amount is 10,000, they say no, tax base is 11,000. There will be 1,000 negative figure. We will call it deductible temporary difference. And if suppose tax rate is 30%, we charge how much is a negative figure we have calculated 300. So that will be called deferred tax asset. In how deferred tax can be calculated using a formula. Carrying amount minus tax base. Carrying amount minus tax base. If the figure is coming positive, that will be taxable temporary difference. So through this, we can calculate what? Deferred tax liability. While if the figure is negative, that will be deductible temporary difference. And through this, we can calculate what? Deferred tax asset. Where asset will be recorded in asset, where liability will be recorded in liabilities. Shall we move forward? Shall we move forward? Yes. Now moving towards that question again. This is the formula they have written. In financial reporting examination, you may have to calculate the temporary difference, the difference between item carrying amount and tax base. If the figure is positive, that will be called a temporary difference. If the figure is a negative, that will be called deductible difference. In positive figure will be called taxable temporary difference. And the negative figure will be called deductible temporary difference. Okay, let's move towards that question again. Now we are going to solve this question using that formula. Here 1, 2, 3. The difference between carrying amount and tax base. What is carrying amount? 600 is the asset cost. If we are charging depreciation 200, the carrying amount at year 1 will be 400. Year 2 will be 200. Year 3 will be 0. What is the tax base? They are saying, no, you need to charge depreciation 240 in first year. What will be the tax base carrying value? 600 minus 240? 360. How we have calculated? 600 minus 240. In year 2, what will be the carrying amount? 240 minus 210. 240? No, 360 minus 210. 360 minus 210, that will be 150. Because 360 carrying amount previous minus 210. And in year 3, that will be 0. How? 150 carrying amount minus depreciation cost. What is the difference? 40, 50, and nil. What is this? Temporary difference. What's the tax rate? 30%. That will be 12, 15, 0. 12, 15, 0. What is that? Deferred tax liability. The same figure we have calculated. Is that the same figure we have calculated? Deferred tax liability. Will they ever ask you guys to actually do it? Yes, we will use this method. No, they can ask you by this method. No, they will not ask about method. But normally we will calculate using this carrying value, tax base. Carrying value, tax base. What is the increase or decrease in tax liability? Here increase of 12. Here increase of 3. Here decrease of 50. Is that? Yes. What was your tax for the year? This was your tax for the year. That was 288, 291, 297, and 315. If you adjust this, you can calculate your tax liability. Tax payable. Is that? You can say tax expense. Okay, let's move forward. Reason, what is temporary difference, what is permanent difference, leave it. Let's move up. Revaluation of non-current assets. Have we studied revaluation? Company can choose policy either recording asset on historical cost basis or revaluation basis. If company is moving toward revaluation basis, what they need to do, they need to compare their carrying value with the fair value or market value. Yes. And if the market value is more, there is a revaluation surplus. Otherwise, there is a revaluation loss. Where we record revaluation surplus? In other companies' income. Where we record revaluation surplus in other comprehensive income. Can you understand this? Let's move forward. That's your understanding too. Please try that. See if you can perform some calculation. Extract mean if they have mentioned the name of component, you need to prepare extract of that. Mean extract of profit and loss account, only profit and loss. If they says extract from the financial statement, whatever, P&L, other comprehensive income if included, balance sheet if included, changes in equity if included, cash flow if included. But financial statements mean all components, wherever the fact is going on. If they name specific, only relating to that specific component. Not complete, extract. So on 1st January 20x8, Simon Company decided to revalue its land for first time. A qualified property valuer reported that the market value of the land on the date was 80,000. The land was originally purchased 6 years ago for 65,000. How we calculate a revaluation surplus or loss? Comparing this market value, fair value with the carrying value. What's the carrying value of land? The land was originally purchased 6 years ago for 65,000. Some more intelligent student will say, okay, 65,000 was purchased 6 years ago. So we can divide 65,000 by number of years. We can calculate a depreciation, but this is what there is no depreciation on that. Its carrying value will remain same. So how much is the revaluation surplus? 15,000. Where it will go? Other comprehensive income and statement of changes in equity. Is that? And the land in statement of financial position will be recorded on what amount? 80,000. This means, according to this first paragraph, there will be effect on three component of financial statement. One will come in profit and loss and other comprehensive income. Second effect will be statement of financial position. We need to record land under non-current assets with 80,000. And we need to record statement of changes in equity under revaluation surplus. There are four components of statement changes in equity: share capital, share premium, retained earning, and revaluation surplus. Whatever is there, we need to record. Okay. The income tax liability for the year ended 31st December 20x8 is 19,400. What does that mean? The income tax liability current year is 19,400. Being based on current year profit, they have estimated tax of 19,400. The difference between the carrying amount of the net assets of Simon, including the revaluation of the land above, mean in difference, revaluation is also included. And their lower tax base at 31st December 20x8 is 27,000. In taxable temporary difference is 27,000. The opening balance on the deferred tax account was 2,600. Simon's rate of income tax is 25%. What is taxable temporary difference? That is what? 27,000. Is that? If we multiply tax rate 25% on it, what amount we are getting? 6750, that is deferred tax liability. Can you explain? The difference between the carrying amount of the net assets of Simon, including the revaluation of land, and their tax base, mean in simple word, the difference between carrying amount and tax base is 27,000. Mean the formula, carrying amount and tax base, what was the amount? The difference is what? 27,000, on which we need to apply the tax. We can calculate deferred tax liability like we calculated here, like this. Carrying amount, tax base, this is the difference, and we calculated deferred tax liability by applying tax rate. Carrying value is of land. Including revaluation of land as well. This means in this, there is a sum part relating to revaluation and a sum part relating to other profits as well. There is some part relating to revaluation gain and some part the profit. How much is relating to revaluation gain? 10,000 multiplied by 25%. 37. If total is a 6750 positive, out of this, if we deduct 3750, what is for other? 3,000. 6750 minus 3750. But one thing we forget. Is there any opening balance of a deferred tax liability? What is it? Where is that? Yeah, we need to deduct this first. We need to deduct this opening balance as well. If we deduct that opening balance, what is that? 2600. If we deduct that 2600 from this, how much value we are having? 4156. What you are talking about? 37,000. He's saying carrying amount less tax base is equal to taxable temporary difference. That is what? 27,000. Read the difference between the carrying amount of net assets of Simon and their tax base at 31st December is 27,000, mean this taxable temporary difference is 27,000. On this taxable temporary difference, we charge tax amount and we calculate deferred tax liability. If this figure is negative, that is deductible temporary difference. Charging tax rate on this, we calculate deferred tax asset. Is that? So deferred tax liability is 6750, while there was opening balance of 2600 that we have deducted. This means the current is a 4150. And in this 4150 revaluation, differences is also included. So what is relating to revaluation? 3750. What is relating to other profit? 4150 minus 3750? 4. This 400 we need to adjust with current tax liability. How current tax liability? Adjustment of under over provision and adjustment of deferred tax liability. And this 3750 will be deducted from revaluation surplus. From revaluation surplus. Why? We're gonna study up there is a paragraph. Now we can prepare extract. First extract is statement of profit and loss and other comprehensive income. Statement of profit and loss and other comprehensive income. In statement of profit and loss, we will record income tax that is charged to P&L. How? Current year liability, that is 19,400. Add, deduct under over provision. Is there any under or over provision? No. Adjustment of deferred tax. Is there any adjustment of deferred tax? Yes, that is given for it. So we will record income tax. How? 19,400. Add this 400, so that will be 19,800 under P&L, profit and loss account. And for other comprehensive income, we need to record what? Revaluation surplus of how much? 15,000 was there. 15,000 was there. Out of this, we will adjust this deferred tax amount 3750 that we will deduct. And remaining, what it will be remaining? 11,250. Yes. So this we have prepared statement of profit and loss and other comprehensive income extract. So from this question, what we have learned, if there is any revalue of asset, whatever is the taxable temporary differences that include difference due to revaluation surplus as well, What we need to do, we need to make a separate deferred tax liability relating to revaluation surplus and relating to other profit. Other profit mean could be depreciation or provision or something else. And revaluation surplus, we do not record in profit and loss account, we record in other comprehensive income. Whatever is deferred tax consequence relating to revaluation surplus, that we will adjust with revaluation surplus. Why we are deducting this? Instead of adding, why we are deducting this? Because in tax, we have added deferred tax liability. Because tax is expense. Revaluation surplus is gain. That's why we have deducted this 3750 deferred tax liability from it. Now we are moving towards preparing a statement of financial position extract. In that, in non-current asset, we will record what? Land with a value of how much? 80,000. What else we need to record? Is there any current asset? No. Is there any non-current liability? Yes. That is what? Deferred tax liability. With how much amount? Complete amount. What was that complete amount? 6750. What else we need to record? Under current liabilities, we need to record tax payable. What was tax payable? 19,400, because in current tax payable, we need to adjust under over provision and deferred tax. Liability will remain same. In this 19,400, current year profit tax, for which we initially recorded the entry tax expense, debit tax liability credit. So that will go into current liability as it is. But for tax charge to P&L, we need to adjust what under over provision as well as deferred tax consequences. In this question, there was only deferred tax consequences that we adjusted. And next, we need to prepare what? Statement of changes in equity. And under statement of changes in equity, we need to record what? Revaluation surplus. With how much amount? 11250. How it is calculated? 15,000 minus 3750. So this we have prepared financial statements extract for statement of profit and loss and other comprehensive income, for statement of financial position and statement of changes in equity. Now you can see this question and see, does it make sense? Because this will be the maximum question examiner can ask from this chapter, including revaluation. From the question, we need to see what are the taxable temporary differences. Apply tax rate on it. Apply tax rate on it, and we can calculate what? Deferred tax liability. Deduct opening balance from deferred tax liability from remaining balance. C. What is relating to revaluation? The other is relating to other profit. That will be adjusted with tax on profit. So now calculate profit and loss tax expense amount. How? Current year tax liability that is given in the question 19,400. Add less under over provision, nothing there. Deferred tax liability, it is positive figure, so we will add. If it is negative, we will deduct. As it is positive, so we have added and calculated P&L figure for income tax. Where this revaluation deferred tax liability will go, this will be adjusted in revaluation surplus. What is total revaluation surplus? 15,000. In that we adjusted deferred tax liability. So that will come under other comprehensive income revaluation surplus. And due to revaluation, what is the new amount of asset record in balance sheet? What is deferred tax liability? Complete. What is current liability for tax payable? The current year tax. And if there is other comprehensive income, that will also move to statement of changes in equity revaluation surplus. Let's take a break for 15 minutes. After break, we will wind up this chapter. So this is a summary that we have covered so far. How to calculate income tax charge to profit and loss account. Year end estimation mean current year tax liability. In that, we will adjust under our over provision. Under provision, we add, over provision, we deduct. And in that, we need to adjust, increase or decrease due to deferred tax. Positive figure added, negative figure will be deducted. So this figure we can calculate for profit and loss account. And how to calculate a deferred tax? Balance carried forward from statement of financial position in according to differences. Balance brought forward as per trial balance, opening balance that we need to adjust. And then we can calculate applying the rate. Test your understanding 3 and 4. Leaving for now, let's move towards test your understanding 5. Good luck everybody with number 1. Test your understanding 5, number 1. Select the amounts that will be shown as an expense in the statement of profit or loss for the year ended 30th September 20X1 and the liability in the statement of financial position at that date in respect of income tax. 30th September 20X1, what you will record to P&L and what you will record in tax payable current liabilities. The following information has been extracted from the accounting records of Clara Company. Estimated income tax for the year ended 30th September 20X0 mean previous year liability was 75,000. Income tax paid for the year ended 30th September 20X0 while they paid 80,000. So there was under provision of how much? 5,000. Estimated income tax for the year ended 30th September 20X1, 83,000. That is our liability for the current year. But in that, we need to adjust under provision whether add or deduct. So 88 will be expense. Is that number 2? 54900. No. What is the amount income tax expense to be recognized in P&L? Current tax liability. In that we need to add under provision or deduct over provision. And in that we need to adjust deferred tax, increase, add, decrease, subtract. So income tax payable current year, that is 60,000. Over provision 4,500, that we need to deduct. And opening provision for deferred tax is this, while closing provision is this. Is there increase or decrease? How much? 600. That increase will be added. 56107. Number 3, please. What is the deferred tax liability? Why we should calculate using formula? That's why. Carrying amount less tax base, positive figure, apply tax rate on it. How much? Piece of machinery cost 500. Tax depreciation to date has amounted to 220. In according to tax, carrying value is 380. And depreciation charged in the financial statement date 100. So carrying amount is 400. And according to them, 500 minus 220 will be tax base. That is 280. There is positive difference of how much? 120. And tax rate is 30%. 36 will be deferred tax liability. Is that? Is that carrying amount? How we have calculated 500, our depreciation is 100. Carrying amount as per tax base 500 minus, according to them, depreciation should be 220. So this is called taxable temporary difference. Number 4. Prepare extract from statement of profit or loss and statement of financial position of WS company for each of the 3 years, showing a tax charge and tax liability, mean balance sheet and P&L figure. On WS company prepared its financial statements to 30th June. The following profit before tax were recorded from 20x1 to 20x3. The entity pays income tax at the rate of 30% and incorporates this figure in the year ended accounts. The actual amounts of tax paid in respect of X1 and X2 were this. So it is tax liability. If the tax rate is 30%, 30,000, 36,000, and 33,000. This means for statement of financial position, the tax liability for 20x1, 20x2, 20x3 will be this. Statement of financial position 20x1, 20x2, 20x3. The figure for tax payable will be 30,000, 36,000, and 33,000. We need to calculate statement of profit and loss, the tax expense current year plus under over premium relating to previous year. For 20x1, instead of 30,000, they paid tax 28,900 when after 20x1. This means for year 20x1, there was over premium. How much? 1,100. That will be adjusted in 20x2 tax. So this means for 20x1, the tax will remain same 30,000. But for 20x2, 36,000 minus over premium, that is 1,100. The difference between these two figure 36. Now the difference between year one payment and year one tax 1,100. So 3,600 minus 1,100. 34. 900 will be tax for year 2. Now this has been calculated 36 minus 11. 1.1. Sorry, not 11, 1.1. For 20x2, the tax amount liability was 36 while we paid 37,200. This means there was under provision of how much? 1,200. That will be added in this. So 33,000 plus 1,200. 34,200. Done. Give me answer for 5.
Second year will it be required as deferred tax asset?
Question number?
This first one only, the second year. Down.
No, there is no deferred tax in number 4. There is no deferred
In
tax.
the second year, what will it be?
Is there any carrying amount tax base?
No,
Why there is deferred tax?
because the deferred tax liability will be negative.
There is no deferred tax liability. There is only under over premium. Is there any carrying amount and tax base difference? No. How we calculate deferred tax?
What is 1100?
How we calculate deferred tax difference between carrying amount and tax base for this paper? Is there any information about carrying amount?
No.
Why there is this under over premium? Because they paid more or less due to whatever is the reason.
Okay, so
If they provide information, the reason was carrying amount was different, tax base was different, then we will move toward deferred tax.
1100.
If the tax liability is this, they paid this, that is under over provision. Is it fine?
And can you just show for the last year ones?
Last year, for 20x2, we paid tax this one, while the liability for 20x2 was 36,000. We paid more. This means for 20x2 under provision, 1200. That will be adjusted when? With the next tax. That is adjusted with the next tax, that is 33,000 plus that under provision relating to previous year.
And it will be, if in case it's over, then we have to deduct.
Deduct, like in year 2, we deducted because year 1 was having over provision. 30,000 was provision and we pay 28,900. So that we adjusted with this 36,000. In year 1, there was no information about previous year under over provision. Is that? Number 5, please. What is the double entry necessary to record the deferred tax impact on warranty provision? First, you need to calculate deferred tax to see whether it is deferred tax asset or deferred tax liability. If it is asset, debit to income tax expense. If it is a liability, credit, what should be in the debit? Income tax expense. We can see whether there is a deferred tax asset or deferred tax liability. Using the carrying value. And tax base. It is positive figure, that will be liability. If negative, that will be asset. Positive means taxable temporary difference. Deferred tax asset. Negative means deductible temporary difference. That is asset. So CP company introduced a warranty scheme during the year ended 31st March 20x1. CP company's statement of financial position at 31st March 20x1 recognized a warranty provision of 65,000. This is the carrying value of not asset, liability in our books. If it is a liability, it is negative figure. If it is asset, it is positive figure. Liability, negative credit balance. Asset, positive debit balance. For tax purpose, warranty costs are deductible when claims are paid. Mean tax authorities didn't allow this as expense. And according to them, what is the carrying value for current year? Nothing. You cannot record this in current year. It will be adjusted, it will be recorded in expense. Next one you will pay. So there is 65,000 negative. This will be called what? Deductible temporary difference, not a taxable temporary difference. This is deductible temporary difference. A positive figure, taxable temporary difference. And we will apply tax rate 20%, and that will come 13,000. This will be called deferred tax asset. Because on taxable temporary difference, we can calculate deferred tax liability. So what is the accounting entry for deferred tax asset? Deferred tax asset debit with the 13,000 and income tax expense credit with 30,000. If it was a liability, we will need to record this entry as a liability credit. This was not covered in the book. There was no information about deferred tax asset, how deductible temporary differences are calculated. They explain in theory, but not according to formula. But we have studied positive, negative. Where? Taxable temporary difference, deductible temporary difference, taxable temporary difference, positive deferred tax liability, deductible temporary difference, negative deferred tax asset. Okay, let's move forward. Yes. Try this 141 question from your BPP kit. I need the correct answer. There are four options: 15.6 million, 15.9 million, 16.8 million, 18.3 million. Similar to test your understanding too. What's meant by debit balance brought forward under provision? Credit balance of tax in trial balance over provision. Why debit under provision? Because it is positive, should be added. Credit balance in trial balance brought forward, that will be over provision, should be deducted. So this debit balance of 2.1 is under provision relating to previous year. And this credit balance of deferred tax, is that liability or asset?
Liability.
Obviously, credit liability. Opening balance of deferred tax liability. The tax charge for the current year is 16.2 million current tax liability. The carrying amount of net assets are 13 million. In excess of their tax base, mean this is taxable temporary difference 13 million given, which include 3 million revaluation surplus. The income tax and deferred tax rate is 30%. What amount of income tax recognized in statement of profit or loss? How to calculate profit or loss figure? Current tax liability, add under provision. In this question, there is under provision and adjust deferred tax increase or decrease. Increase will be added, decrease will be deducted. You need to see whether there is increase or decrease. How? Taxable temporary difference. That is given how much? 13 million. I'm taking it into 1,000. 13,000. What is the tax rate? 30%. If we apply 30%, that is what? 3,900. That is what? Deferred tax liability because it is positive figure. Is that? But is there any opening balance of deferred tax liability given? Yes. How much is that? 5,400. So we arrive at how much? How much? 1,500 negative. In this negative, there is a relating to revaluation surplus and relating to other profit. Revaluation surplus, they have stated 3 million revaluation surplus. 3 million, we can say 3,000.
Yes.
Multiply by 30%. How much is that?
900.
900 positive. If we are just 900 positive with 1,500 negative, what could be for other profit? I'll kill you.
What? 10
900 positive and 1,500 negative. 2,400 negative. Where it should be adjusted? With this, what is the current year liability? What is your current year liabilities are given in the question? How much is that? 16,200. What is under provision? 2,100. Is there any decrease or decrease in deferred tax? Decrease. What is P&L figure now? What is P&L figure now?
15.9.
How I get this 13,000? This 13 million. Taxable temporary difference. How? The carrying amount of net assets are 13 million in excess of their tax base. Mean carrying amount next tax base minus tax base is equal to what? 13,000 positive. How much is that?
Option 15.9.
Option?
B.
The similar question we have covered. Only the difference is this figure is coming negative. Sir? They have provided you this information carrying amount and tax base is more by 13,000. Means there is no information about carrying amount and tax base. They have provided you the taxable temporary difference.
So you start solving the question from the deferred tax part.
Yeah. What is carrying amount? What is tax base? What is the difference? In this question, they have provided you the difference. Positive mean taxable temporary difference. Multiply tax rate, defer tax liability. If negative amount, deductible temporary difference. Multiply by tax rate, defer tax asset. Whether asset, whether liability, we need to see whether this is positive or negative. That will be adjusted in current tax liability. This was the first formula that we learned. Current tax liability, adjust under over provision and adjust increase or decrease in deferred tax. And in this question, there was deferred tax liability and decrease in deferred tax liability. Shall we move forward? Verse 142. Good luck, everybody. Same. The format will be same, but the amounts and under over provision might be different. So what he is asking about, P&L figure. This means current tax liability. In that we need to adjust under our over provision, under added, over deducted, and deferred tax increase, decrease. The total will be answer. Debit balance of 700. Under provision, over provision. Debit balance under provision, over provision. Debit means positive. That should be added. Credit means negative. That should be deducted. So they have given us under provision and a credit balance of deferred tax liability, opening balance 8.4 million. The doctor have estimated the provision for income tax for the year 44.5 million. In this figure is given. And the required deferred tax provision is a 5.6 million. Instead of providing taxable temporary difference, they have provided you this figure. Deferred tax provision required. That is 5.6 million. So deferred tax liability is given 5,600 Is there any opening balance? How much is that? 8,400. So we are having negative balance of how much? 2,800. Out of this, 1.2 million is relating to property valuation. They have given this figure. In revaluation, they have given 1.2. So what is remaining for other profit? 4,000 positive, negative? Negative. That will be adjusted here, and under provision should be added 700. What is that? 1.2 million. Similar to that, as your understanding too. Only the amount we need to see what they have provided. In as your understanding too, they provided this. While here in 141, they have provided directly this. In 142, they have provided directly this. Is that? Shall we move forward? 143, please. We need to calculate premium for deferred tax required at 31st December 2026. In previous question, what was given? Taxable temporary difference amount. We need to charge tax. That is given here is a 30%. We can calculate deferred tax liability. From that, we need to deduct opening balance. This balance include revaluation and other. Is that? Now this question, they have provided you this value, they have provided you this value, they have provided you this value. You need to calculate deferred tax liability. So at 1st January 20x8, start of the year, the carrying amount of non-current assets exceed their tax written down value by 850. So through this, you can calculate this opening balance. 850 multiplied by tax rate. Or you can say the opening balance without charging tax is 850. Number 2. For the year to 31st December 20x8, the entity claimed depreciation for tax purpose of 500 and charged depreciation of 450 in the financial statements. Depreciation for tax purpose is 500. Why? Charge to actual 450. And there is increase of profit by 50 without charging tax. Relating to this. During the year 31st December, the entity revalued a property. The revaluation surplus was 250. Relating to this, but without charging tax. So revaluation, that is 250. If we add all these, how much is that? And if we charge tax on it, how much is that? 30%. What is that? This is our answer. And they have given this value, but without tax. See, this amount we need to calculate. And this amount is a combination of opening balance as well as two of these balances, but with the tax. Even if you charge 30% on this record here, charge 30% on this record here, charge 30% on this record here, so you can find this value. Is that? Because this value is a combination of these three. Because first we deducted this, and then we deducted this to become it nil. 850 is the opening balance without tax.
Yeah.
50 is relating to other profit for the current year. And 250 is relating to revaluation. All three amounts we taken without tax, added, and then put a combined tax 30%, 345 is the value. Is that? Or calculate 30% of this 50 here, calculate 30% of 250 here. You will move toward this figure. And then calculate 30% of 850, you will find this figure. And then by adding both these figure, you can calculate this. Is that 144, please? This is mathematics. What you want to calculate what amount of tax was paid during the year 30th September 20x2. How much tax they paid during 30th September 20x2. During 30th September 20x2, which year tax you pay? 20x1 or 20x2? 20x1. How much you have paid? That you need to calculate. 20x1 tax liability was 160. But obviously you paid something different. They have provided you 20x2 P&L figure, 270. How this was calculated? Current tax liability plus minus under are overpaid over provision at minus over provision and then deferred tax adjustment. And they have calculated this figure P&L charge to P&L as 270. Is that? What was current year tax payable for 20x2? Is there any information about under or overpaid? No. But is there any information about deferred tax increase or decrease? How much is the increase? 170. Through this, can you calculate any under or overpaid? If this both together becoming 300, we need to move toward 270. This means 30 should have been deducted from here. This is what? Over provision relating to previous year.
Yes.
Over provision relating to previous year. What was previous year liability? Previous tax liability was 160. If there was over provision of 30, how much you paid? Sir, how much you paid? 1/3. because your premium was over by how much? 30. So what was your premium? 160.
Mhm.
So what amount of tax was paid during the year? The figures are in millions, so 130 million.
Mhm.
Don't forget this far. In current year tax liability, we need to adjust under over provision and we need to adjust increase or decrease in tax. In every question, we are using this form. We are using this form. If there is a deferred tax, we are using that. If there is no deferred tax, we are just using under over provision. If there is no under provision, just adjust deferred tax. 145. And then we call it a day. What amount income tax charged to PNL? This figure they want. In previous question, there was options. Now there is no option. So what is this credit balance of current tax? Or that should be deducted. And 2.6 million on deferred tax. What is that? Asset or liability? Liability because credit balance. So 2.6 million deferred tax liability figure is given. But this is opening balance, you know.
Yes.
That we need to deduct from front view. A property was revalued during the year, giving rise to deferred tax 3.75 million. Mean relating to revaluation, the deferred tax liability is 3.75 million. This has been included in deferred tax provision of 6.75 million at 31st March. 6. 6750. What's the difference?
415.
4150. Out of this, how much is for revaluation? 3.750. What is relating to other profit?
400.
400.
Wait, in this question,
Hmm?
Yeah, 400.
in this,
Only the amounts are different.
Yeah.
And income tax liability is 19,400. This is a different question. In that question, might be there was carrying value and something was given. So we need to adjust. This is positive figure or negative?
Positive.
What's the answer? 19 million.
Yes.
That was different question. Figures a little bit different. In that question, we calculated this figure. There was tax rate given. That's it for today. We'll see you in next class.
This, um,
Yeah, new chapter.